I'm Bob Calling with Market Trader Tao, and we're going to continue our series on chart patterns. And today we're going to talk about wedges. Now, there's two different kinds of wedges. You have a rising wedge and a falling wedge, and we're going to talk about both of them. Now, typically, your rising wedge is a bearish chart pattern, and your falling wedge is a bullish chart pattern. Now, wedges a lot of times are confused with the term triangle, but wedges really are not triangles because triangles are relatively mid-term duration type formations, where a wedge is considerably longer, and we're going to talk about that now. Now, typically, on a wedge, you're going to have your basic chart pattern. You have phase 1, 2, and 3. Now, wedges will usually happen at the top of your phase or at the bottom of your phase, but a wedge, it starts out to be, it looks like a continuation for a short period, for a period of time. Now, when you're looking at a wedge and you're seeing it, it's a lot of times I find it to be a very difficult pattern for people to pick out because they are kind of prolonged and they take a while for them to develop, and many people miss them. But what's going to happen is if you have, let's say, your normal time frame is going to be, let's say, 90 periods, you know, from here to the top of the beginning of your wedge. The wedge could take, again, another 90 to 180 time periods. So it does prolong. It's quite a bit longer. And what will happen, if you're wondering what that noise is, that's my Labrador Retriever, Jack. And you'll begin to see the same type of pattern develop that you would on a triangle, but what will happen is it'll be more of a cone shape, and you'll hit a cycle here, and then ultimately it will fail. Now, sometimes these patterns are large enough that you can trade them very much like a channel from the top to the bottom like this, and then wait for the breakout. But typically, when you have a rising wedge, that is a sign that you're going to have a reversal. And if you have a falling wedge at the same time, now if it's in a downtrend, a falling wedge will be considered a reversal in the other direction. And that's how those work. Now, rising wedges are always bearish. They tend to, doesn't make any difference which direction of the trend they're coming from. In other words, if let's say you're in a downtrend and you have a rising wedge pattern, and those patterns tend to funnel toward each other, that's going to be bearish. And the reason why it's bearish is because your tops are slowing down. They're actually getting smaller, and these two lines are converging, and so it creates a bearish bias. And so now in a downtrend, of course, that's a continuation, but in an uptrend, okay, if you have a bearish wedge, then it's going to continue to be bearish. Okay, and the same the other way around. If you flip that over, you take this whole thing and flip it up, you're going to this is where a lot of traders get confused, because basically what you have is basically what you're going to have here is, if you have a falling wedge, if you're coming down out of a downtrend, then that's considered to be a bullish pattern. The same as if you're coming up from an uptrend, then you have a falling wedge. That is considered to be also bullish. So anytime you see a rising wedge, you're going to have a bearish situation. And if you have a falling wedge, it's going to be a bullish reversal. And that's wedges. The next thing we're going to talk about is channels, because sometimes wedges can turn into channels, or channels can turn into wedges. So that's what we're going to talk about next, and then we'll be on to head and shoulders patterns and cup and saucers.